They rarely ring a bell at the top of a market cycle, and nor do they post a warning at the outset of a financial crisis. Financial shocks unfold in quiet, almost imperceptible ways at first, behind closed doors, within obscure corners of the market, in the fine print of central bank balance sheets. By the time the headlines catch up, the damage is already done. But there are those who see it coming. And they are not found on trading desks or in television studios. They are the central bankers, the very stewards of the financial system who, despite their public reassurances, have been quietly buying gold at an historic pace. The question is not why they are buying it. The question is why you aren't. You aren't buying gold because they don't want you to. Most investors remain where they are, exposed, complacent, and utterly unaware. And perhaps that is the point. Perhaps this is precisely what the architects of the system intend. They need investors to stay calm, to keep buying the debt, to keep believing that this time is different. They do not want you to buy gold. Because crises do not begin with panic. They begin with silence. And that silence has already begun to crack. It is tempting when contemplating the world of finance to assume that the worst is behind us, that the chaos of 2008 and the crash of 2020, the crises of decades past, were somehow aberrations, that they were freakish accidents of human folly that the guardians of global finance have since learned to prevent. It's comforting, reassuring even, to imagine that the reforms, the regulations, and the stress tests have rendered the system safer. But to believe this is to fundamentally misunderstand the nature of financial crises. They are not external shocks, and nor are they random accidents. They are features, not bugs, of the very system itself. These are the inevitable consequences of leverage, complacency, and the delusion of permanence. And today, across every corner of the global financial system, the same vulnerabilities that have undone past generations are not only present, they are flourishing. The warning signs are not hidden. They are in plain sight for anyone willing to look beyond the distractions of daily market movements. Consider, for example, the steady resurgence of dangerous borrowing practices cloaked in complex jargon, but identical in spirit to the speculative excesses that preceded the global financial crisis. And investors, lured in by the siren song of easy returns, are once again engaging in vast carry trades, borrowing cheaply, often in foreign currencies, to pursue higher yields elsewhere. And such trades depend entirely on the illusion of stability, this assumption that exchange rates will remain steady, that asset prices will glide upward, and that liquidity will always be available at a moment's notice. But illusions, as history repeatedly reminds us, do not endure. When volatility returns, and let's be honest, it always does, these positions unravel with speed and violence, triggering fire sales, margin calls, and forced deleveraging. And meanwhile, in the shadows of the system, other risks gather force. The quiet but persistent growth of risk parity funds and options-based strategies has created a precarious dependence on the idea that volatility can be tamed. And these funds, designed to maintain constant risk levels, must liquidate assets precisely when prices fall and volatility spikes, thus ensuring that the downturns feed upon themselves. And worse still, the scale of so-called relative value trades, those that bet on the relationship between seemingly stable financial instruments, has reached unsettling heights. The basis trade, which hinges on the convergence of treasury prices and futures contracts, is now counted in trillions. It is a trade that assumes stability in a world that has rarely looked more unstable. And then there is the creeping embrace of illiquidity, the quiet migration of capital into opaque, unlisted private markets where valuations are murky, cash outs are difficult, and risk is both hidden and unquantifiable. And investors are told that these assets offer higher returns in exchange for reduced liquidity, but they are rarely reminded that in a crisis, illiquidity is not merely inconvenient, it is fatal. And perhaps most concerning of all is this renaissance of financial engineering, the same securitization, synthetic risk transfers, and structured credit products that turned toxic in the last crisis. They have returned, repackaged and renamed, but fundamentally unchanged. These instruments rely on complex models and optimistic assumptions to justify the slicing and dicing of risky loans into supposedly safe tranches. But no model however sophisticated, can withstand the brute force of a market panic. The underlying weakness in all of these examples is the same: leverage. Not just explicit borrowing, but embedded leverage, hidden in derivatives, options, and structured products, and exacerbated by the belief that central banks will always step in to prevent disaster. And yet, even that comforting assumption is fraying. Major central banks now find themselves constrained by swollen balance sheets and persistent inflation. And interest rates, though no longer at those emergency low levels, do remain historically low, limiting the ability to cut further. And governments, meanwhile, are weighed down by record debts and rising political dysfunction, with fiscal space shrinking under the pressure of war, social demands, and aging populations. And in short, the cavalry may not be coming next time. Because when this house of cards begins to collapse, and believe me, collapse it will, the sequence of events will be familiar. First, falling asset prices will trigger margin calls and collateral demands. Investors will scramble for cash. Selling what they can typically means the most liquid and least distressed assets first. Volatility will soar, correlations will break down, and what once seemed diversified will suddenly move in unison. The illusion of liquidity will evaporate, with fewer market makers and trading dominated by funds that consume rather than provide liquidity. Prices will gap lower in violent, disorderly moves. And amidst the wreckage, the final cruel irony will emerge. Many investors will have believed that they were protected by diversification, spreading risk across stocks, bonds, property, and funds, only to discover that in a true crisis, when correlations break down and liquidity vanishes, that form of diversification offers no refuge at all, because real diversification isn't about owning different slices of the same collapsing system. It's about holding assets that stand entirely outside of it, and central banks know that. Few assets meet this test. Gold does. The most dangerous belief in financial markets is that this time is different. It rarely is. Consider the warnings already emerging from some of the most powerful voices in finance. And beneath all of this, the spectre of political interference looms ever larger. America's ongoing feud between its executive branch and the Federal Reserve threatens to upend the fragile balance between monetary stability and political expediency, thus raising the prospect of a crisis sparked not by market forces, but by deliberate, if short-sighted, political action. And these are not the only fault lines. Climate risk, once dismissed as a distant concern, has now entered the conversation as a credible source of systemic instability. Insurers are withdrawing from disaster-prone regions. Mortgage markets face strain from falling property values, and entire regions could soon become uninsurable, and so by extension, unfinanceable. These risks are distinct, but they share a common thread. They are rooted in fragility. They are rooted in the overconfidence of financial actors, the complacency of policymakers, and the mistaken belief that every crisis has a convenient solution. But there is one element of the financial system that stands apart from this growing web of interconnected risks: gold. Unlike paper assets, gold carries no counterparty risk. It is not dependent on liquidity, collateral, or the benevolence of the central banks. It is not vulnerable to the failures of governments, of the dysfunction of politics, or the greed of financial intermediaries. It requires no confidence to function. It simply is. And that is precisely why it has endured for centuries, for millennia, as a refuge when trust collapses. Believe me, it is no coincidence that the very institutions tasked with maintaining financial stability, i.e. the very same central banks now contending with their own credibility crises, have been quietly but persistently accumulating gold at a pace unseen in decades. In public, they speak of inflation targets, of interest rates, of monetary policy, but in private, through their actions, they are hedging against the very risks that they themselves have created, daring not to fully acknowledge aloud what is going on. The headlines documenting record central bank gold purchases, they are not mere curiosities. They are signals. They are flashing warnings that those closest to the heart of the system no longer trust it entirely themselves. In every financial crisis, there comes a moment of clarity. It's a moment when the illusions are stripped away and a very hard truth emerges. The truth that systems fail, that safeguards are often mere words, and that wealth built on leverage and liquidity is as fragile as the confidence that sustains it. And in those moments, Investors do not seek complexity. They seek certainty, stability, and simplicity. They are seeking gold. So are you going to keep believing what you are being told by the very institutions who are the architects of all this? Or are you going to start following their actions instead? Are you going to be your own central bank and start preparing just as they are? And if you want to get started, why don't you click on the link below and download this guide today?